Welcome to another Maine SBDC webinar. Today we are going over the basics of financial reports, and we are very lucky to have Maine SBDC Business Advisor Tina Oddleifson here with us to go through all of these financial documents. We know it can seem pretty overwhelming as you get started, but she's pretty great at explaining things in a very understandable, piecing things together so that it all makes sense in a big picture way, which I really appreciate. So I hope that she's able to help you out today as well. Please submit any questions you have at all for her in the chat, as well as introducing yourself. Let us know where you're calling in from, perhaps what industry you're in, or if you have a business, share that information with us. This is a great networking opportunity. Also, if you are not familiar with the Maine SBDC, we are the Small Business Development Center of Maine centers. We are all over the state. We are currently meeting via Zoom, so we can meet you anywhere, really. But we do have centers all around the state filled with business advisors who are available to help you with any questions or needs or resources for your small business. Everything is zero cost to you and confidential. So if you have not reached out for advising, please do so. All of our contact information will be included in a follow-up email that you will receive from me after today's show. It will also include a link to the recording of today's session and some resources, so the slides, and I think there's a little extra something. So keep an eye out for that email. And otherwise, I will pass it over to Tina.
Hey everyone, thanks for tuning in here today. As Kelsey said, my name is Tina Oddleifson. I'm a business advisor with the Small Business Development Center. I'm out of the USM Portland campus, working from home like everyone else these days. And we are here today to talk about understanding financial reports for your small business. And I do understand that this is a topic that a lot of people find a little bit intimidating because there's a lot of jargon that can go along with finance. And what I'm hoping to do today is just make it a little bit more approachable, a little bit more fun. But no question is a dumb question. We're going to hold off on the questions till the end, but please throw them in there. But what we're going to be doing today is talking about the three biggies. Within the world of finance and accounting, there are three major financial reports. The first one is known as the income statement, and that is also known as a profit and loss or a P&L. So if you've seen that terminology, it's talking about the same exact thing. It's just more names to confuse everybody. We're also going to be talking about the balance sheet, which is a statement that a lot of small business owners tend to ignore. And we're going to talk about the great information you can get off of that. And we'll also talk about the statement of cash flows, which shows you the flow of money in and out of your small business. And we'll be talking about why that's actually different than your income statement, which is also tends to be a little bit of a point of confusion. But I wanted to start first by just talking about who needs your financial reports. If you are just a solopreneur and you have, just a side gig, you still need to report that income to the IRS. And that, whether you're working with an accountant or not, that information comes off of an income statement and sometimes off of a balance sheet. So every year you need to have this information no matter what for the IRS. You also, if you ever intend to get a loan or attract investors to your business, or if you ever plan to sell your business, you're going to need to produce typically 3 years of profit and loss statements, a balance sheet. If you're applying to a lender for the first time, then they are going to want to see cash flow projections. All of these people need to see your financial statements. It used to be that you could just give people your tax returns, but that is no longer the case. Another group of people are grantors. There's not a lot of free money out there, but this year, because of COVID, there were a lot of forgivable loans, i.e. a grant, and grants. And the people who were really able to take advantage of those were the people who could produce their financial reports. And it was kind of tough to see because some small businesses really were not in a position to produce these reports. And because of that, they were unable to get the grants. So another good reason, another group of people who wants them. But most important is you. Your financial reports are really like the roadmap of your business, and it's the story of your business. It's just being told with numbers, but it gives you actionable information. These are the kind of questions that keep small business owners up at night. I know they did for me, and your financial reports are the place that you can go to give you that information to either answer these questions or to at least figure out how to answer these questions. And so you are the most important person when it comes to the person who needs to look at your financial reports. So before we dive into each one of these, I first just want to offer you a visual. I know a lot of people are visual learners like I am. So I want you to think of your business like it's a fruit tree. And in this case, this is an apple tree, and you're in the business of selling apples, growing apples and selling apples. And to understand what's happening with the health of your tree, there's several different areas that you need to know about, right? And that's what each of the financial reports does for you. So for example, you need to know how good you are at producing your product and selling your product. So producing your apples and selling your apples. That information shows up on an income statement. That's the statement that shows you the revenue you bring in from your sales and the expenses that go out from conducting your business and the profit at the end. We look at that over a period of time, which is an accounting cycle, which is a fiscal year. And then we start all over again the next year, just like fruit on a tree. We go through this cycle and we start again and start from zero. So that's the income statement. But there's some really important information you still need to know about this tree to know if it's healthy, if it's sustainable, right? So the other big piece of information you need to know is how strong is the trunk? Is this trunk and the branches, are they growing over time? If it's not growing over time, the tree is going to fall over. That information shows up on a balance sheet. And it's if we cut that tree in half and we looked at the growth rings, we would see each year that it grew a lot, a little, not too much at all. That information is like your balance sheet. And what a balance sheet is collecting is it's showing you all of your assets. That's everything that you have as a business that has value, like equipment and vehicles and real estate. It's all, and your bank account. It's also showing you what you owe to other people. That's liabilities. And then the difference between those two things is called equity. And that is the same exact concept as a net worth statement for an individual. So if you sold off all your assets and used all the money to pay off all your liabilities, what you'd be left with is your equity or your net worth. And it's really important over time that you grow your net worth because you want to keep reinvesting in your business. You don't want to take all your money home as profit every year because you need to leave some in to keep this tree system strong. And that's really what a balance sheet is going to show you. And then the third major area is the root system and the water that's getting to the root system. To be healthy, you need water, right? If we run out of water, the tree is going to die. That is the same idea as a statement of cash flows. That is the financial statement that is mapping the money flow in and out of your bank account. And that is a little bit different than an income statement, which is a point of confusion for some people. So we're gonna tackle that. But I just want to say that one of the top 3 reasons that businesses fail is not understanding their cash flow. So this is a really important piece. But we're going to start off looking at an income statement. This is a made-up statement for a made-up company that I made up called Midcoast Orchard and Pies. And This is a company that has an orchard on their property, an apple orchard, and then they built a small commercial kitchen to make pies, family-owned company. So we're gonna look at each part of this. I love my laser pointer. So at the top of every income statement is income. That's showing me the revenue I've brought in from sales. These numbers don't necessarily represent cash. Why? Because I can sell my pies to a local grocery store and they might pay me later. But the minute I give them the pie, I book that as income. So we have our total income with these two revenue streams. And then we have this section called costs of goods sold. This is just a fancy name for direct costs. It's the costs that are directly associated with producing your product or your service. And the only reason that we separate them out from the rest of our expenses is because it gives us a really important analytical tool. And we're going to look at that in the next slide. But it really helps us see how efficient we are at creating our product in the first place, so that we know whether we have enough gross profit, which is this number, to cover all the rest of our expenses and to create profit. It's not enough just to break even if you pay yourself, because you need to create profit so that you have that money left over to reinvest in your business and to replace your assets, maybe make a new website. Profit's important, otherwise you don't have a sustainable business. So the next section down here is our expense section. And these are expenses that pretty much every business has. This is a short list for demonstration. But expenses are operating expenses. They're known as indirect expenses, and they can either be variable or they can be fixed. Fixed expenses are the things that you know how much you have to pay and you commit to paying those ahead of time. So that's things like rent and insurance. It's the type of expense you want to be particularly careful with, because you're going to have to pay this no matter how many sales you have. So you want to be careful with that one. Variable are things like advertising. You still have some control over that. So we have our total expenses. We subtract that from our gross profit, and we get this net ordinary income number. After that, you will often see something called other income and expenses. All this is a place to track things that happen in a business, income and expenses that happen that are not part of the normal operations of the business. So we don't want to put it in with our regular expenses. So in this case, that 376 represents tools that my business sold because they didn't need them anymore, but they're not in the business of selling tools. So we put it on the bottom. So we end up with this $46,294 for my business for the year. And I want you to remember that number, 46,294, because it's going to show up on our other income statements. So then we ask ourselves, so what? Is this good? Is this bad? I don't know. Every financial statement is only relevant within the context of something. So we compare these to our prior year's performance. That's one major way that we use a financial statement like this, because that gives us actionable information. If we start seeing that we are not making as much money, then we need to look at that and untangle that. The other way that we can look at this is to compare our numbers to our industry. If you Google your industry, you can come up with gross profit margins and net profit margins that are typical for your industry. And that can be a good way just to see how you're doing. And we do that through something called financial ratios. And financial ratios are not complicated. They're just showing us these numbers as percentages of each other. So for example, on our income here, I can see that 60% of my total income comes from pie sales and 40% comes from apples. That's a good thing for me as a business owner to know. Also, because later on I can untangle and take the profitability of each item I sell to determine if I should be selling it. And we'll get into that in a second. So the second major area, and if there's anything that you take from this entire hour together, it's this. The cost of goods sold section is really important because I would say that this gross profit number is the most important number on this sheet. And the reason for this is the number that tells you whether you're making enough after you just make your product to cover your expenses and to create a profit. And if this number is too small, then you have some fundamental questioning to go through. So basically what we do in this section is we just take each of these costs and we divide it by our total income number. So what is that telling us? It's telling us that for every dollar of revenue I bring in, 15 cents is getting spent on food costs and 15 cents is getting spent on my labor just to produce this product, the apples and to pick the apples. That means that my total cost of goods sold is 47 cents for every dollar. That leaves me 53 cents left to cover the rest of my expenses and to create profit. This number is relevant mostly to your industry, but it's also relevant to your history. So if you were looking at this number on a regular basis, at least a quarterly basis, but definitely biannually, you want to ask yourself, is this number changing? If this number is going down, it's giving you some really, really critical information that you need to act on. Excuse me. What that's telling you is something happening with your labor? Has labor become inefficient? And if so, why? Is something happening with your food costs? Is that inefficient? Are you not using your food as efficiently as you could be? Or has your vendor prices gone up and you have not raised your own prices? Small businesses are just notorious for not raising their prices because they think they're going to alienate their customers. And what often happens is they don't raise them, and then suddenly they're in trouble. And then they have to raise them a lot, which does kind of piss off their customers. So, so really important to keep track of this and to be asking questions about your pricing and your efficiency. And again, there's no hard and fast rule about what that percentage should be. It is based on your industry, but I would say that if you are getting below 30%, then you're probably getting into some trouble. So then the rest of this is telling us that our other expenses are 43% of every dollar, which leaves us with 10 cents on every dollar. Again, it matters compared to your history and it matters compared to your industry. A really notorious low margin industry is our grocery stores. They make 1 to 2% profit margin. Restaurants make 3 to 6%. And, so with grocery stores, they have to have a lot of sales in order to make it worth it to be in business. So that's an income statement, and that's how you look at an income statement as you think about your own business. And next we want to talk about the balance sheet, which is definitely the one, as I said, that a lot of businesses don't even, I know business owners who don't even look at this, but there is so much great information here. And there's some information that you can't get anywhere else. So you do need to look at your balance sheet. And again, it's like looking at the growth rings on a tree. Or it's like another way to think about it is that, at the holidays when you take your family photo and you send it out to all your friends and family and they look at it and they say, oh, so-and-so has grown or gotten their braces removed. You're taking a picture of the progress of your business. And you're taking it at a point in time as opposed to a period of time. So typically, December 31st, people are looking at their balance sheets and they're comparing to what happened, how it looked compared to their previous year. So there's 3 things that we talked about earlier that are on a balance sheet: assets, liabilities, and equity. Assets are things that you own that have value into the future. So that's not an expense of your business. It's something you bought that has value going forward. So assets are always broken up into current and fixed, and that matters because current assets are things that we can turn into cash within a year, and that matters because it tells us how able we are to pay our bills. So the first major asset that every business has is the money in its own bank account. Accounts receivable is an asset that a lot of businesses have. And just quickly, accounts receivable, all that is if you are a business that invoices your customers, so they don't pay you when they're in front of you, you provide your product and service and you bill them later, invoice them later. That shows up, that amount of those invoices shows up as accounts receivable. It's considered an asset because you made that sale. That sale is in your revenue numbers. You just haven't gotten paid for it yet. When someone pays their invoice, that amount moves from accounts receivable into your bank account. And then there's inventory, which can be either raw materials or your finished products. So those are typical current assets. And then under fixed assets, those are the bigger things like furniture and equipment and vehicles and real estate. All those things can be sold, but typically, you know, it takes a while to sell them. So we put them under fixed. On the liability side, same thing. We have current liabilities, and these are things that you have to pay off in a year. It can be a line of credit from a bank, which is basically like a credit card, but without the plastic. It can be your credit card balances, and it can be accounts payable, which is the flip side of accounts receivable. If you go into the hardware store and you take a bunch of stuff out of the hardware store and you signed it on a house account, you purchased it that day, but you haven't paid for it. So you need to keep track of it in an accounts payable line on your balance sheet. You don't see that on an income statement. It's really important information to know how much you owe other people, because that gets calculated as part of the value of your business. Long-term liabilities are mortgages, loans that take more than a year to pay off. And then there's this equity section, and that's sometimes a section that confuses people. But again, the easiest way to think about it is like a statement of net worth. If you sold off all of your assets and used that money to pay off all your liabilities, what you're left with is equity, your portion as the owner of the value of your company. So under the equity section, that number gets impacted by two major areas. One is called owner's capital. So when you set up your business for the first time, oftentimes you go to the bank, you open up a business bank account, and you put money in from your personal account, right? Because that's where the money's coming from. That is called an owner's investment. And so the money went up in the bank account, and so did your equity, because assets minus liabilities equals equity. So that owner's capital was the reason that our asset went up. The flip side of that is an owner's draw. A lot of times small businesses do not pay themselves as employees. Some do if you're what's called an S Corp, but if you're not, you are probably just taking money out of your business bank account to give to yourself when you need it. That's your pay. That's called an owner's draw. It's not an expense of your business. It's just a change in your equity position in the company, in the business. The second major place that equity gets impacted is by retained earnings, and that just represents the accumulation of profit over time. As your profit accumulates, money goes up in your bank account, the retained earnings go up, that's yours as the owner, that's your equity. So assets minus liabilities equals equity is one way to think about this, but I would not be telling you the whole story if I didn't explain to you why it's called a balance sheet. So the real fundamental accounting equation is that assets must equal liabilities and equity. And that's one that sometimes throws people, but a really simple way to think about this is that assets are paid for with liabilities and equity, or financed. So for example, if I go out and I buy a $30,000 truck for my business, my asset increased by $30,000, but I also took out a $30,000 loan to pay for it. So therefore, those things are still in balance. If your assets do not equal your liabilities and equity, it means that there's something wrong with your accounting records. And another way to think about this, if it's easier to think about it, is that liabilities and equity have claim to the assets. So if you go out and purchase a piece of real estate for your business and you take out a big mortgage, the bank has claim to that asset until you pay it off. You know, you have claim to that asset and your equity grows as you pay down that mortgage. So those things stay in balance. Assets can also be just paid for with their own with assets. So for example, exchanging assets. If I paid for my $30,000 truck with the cash in my business bank account, I would just be replacing one asset with another asset, but this would still stay in balance because I'd withdraw $30,000 and I would increase my asset of a truck by $30,000. So you don't have to get too concerned about this, but you should understand why it's called a balance sheet. And we're going to look at our Mid-Coast Orchard and Pies. And this business has money in its checking account. It's got money that some of the grocery stores owe it for its pies. And then it's got all this fixed assets because it's kind of a farming and baking operation. You'll notice that there is this thing called accumulated depreciation. That is known as a contra asset account. And what it is it's just reflecting the loss of value of these assets, because every asset except for land depreciates over time. It wears out. You have to replace it. So it's not worth as much. The more you drive the truck, the less it's worth. That has to get reflected in the value of your business. And that's done through the accumulated depreciation line. There's rules for how that gets calculated that we're not going to go into, but there's some very specific calculations that get made depending on the value of the asset. And then notice down at the bottom here that these total $729,167, which is exactly what my liabilities and equity total. So on this side, I've got some current liabilities. I haven't paid down my credit card. I owe my local store, my local hardware store, $1,250, and then I've got a mortgage on this property. So that all equals $402,000. And then on the equity section, I have money that I've invested in my business over time. And then this year I took a $20,000 draw. So my owner capital is worth this. And then my retained earnings, that represents past profit. And then here's that $46,294 that I mentioned you should remember. At any time before you close out your books for the year and start again in the new year on your income statement, you're going to see what's happening this year with your business. So really, a balance sheet is showing you everything about your business. It would be too messy to have, the income statement reflected right on the balance sheet itself. So that's why the income statement was created, but it's basically getting summarized right here. When we close out the books, that would get, for the year, that would then get rolled into retained earnings. It's possible to be in a negative equity situation. If you are having loss after loss in your business, these retained earnings are going to go down and down. So you can absolutely be losing equity, or if you take out too many loans, you can lose equity. So then we're back at this point of so what? So what is this telling us? And there are people in the world who are financial geeks whose only job it is to look at the balance sheets of major corporations and to do all kinds of financial analysis to tell investors whether it's a good investment. There are literally dozens of financial ratios that they use to figure this out. You as a small business owner don't need to know all those, but you should know some basic ones, because the balance sheet, what's important here is really the relationships between assets, liabilities, and equity, because that's telling us some important information about your business. So for example, one ratio that's very common that lenders will look at, but you should be looking at, is what's called a current ratio. And all that is it's comparing your current assets to your current liabilities. a ratio of 1 would mean that those things were equal. And the reason that we care is because it tells us how well you are going to be able to pay off those current liabilities, because you owe them this year. My business is in really good shape here. This ratio, if I divided my 40,810 by my 5691, I'd get like a 7 or an 8 or something. That's really high. If it was reversed and I had 5,600 in the bank and I had $40,000 of current liabilities, I would be in trouble. That would be way below 1. So that's a number you always want to be looking at. What kind of ability do you have to pay off this debt because it's due this year? And a very similar one to that is how working capital gets calculated. Working capital is a term that gets thrown around a lot. Really, all it is, it's like the cushion in your bank account. It's the definition is current assets minus current liabilities, and that gives you what's left that you have in assets. And you want that number to be big enough so that you can handle any unforeseen circumstances, except maybe a pandemic. And you also need enough to deal with seasonal cash flow changes, because it's very common for businesses to get into a situation where they have not yet received money from the invoices they sent to customers, but the expenses are due to their vendors. And that's one of the biggest reasons that businesses can fail, is not understanding that relationship and not having enough working capital to cover that timing problem. So that's working capital. And then another one, really simple one, looks at the relationship between liabilities and equity, or debt and equity. Because it's important to ask yourself, of the assets that I own, of the real estate and all the stuff that my business has, how did I finance those things? If I financed it with too much debt, I need to look at that. And it's absolutely fine to have debt. Every business has debt. You need debt in order to grow. But you need to keep looking at the relationship between debt and equity. Generally, having a 1-to-1 relationship is okay. Less is better, where you have more equity than debt. If you're getting towards a 2, where you have twice as much liability, that's not so good. So these are just a few little tools that we use to examine how healthy, how sustainable is a business. And these are the kinds of things that lenders are going to look at, but you really need to know too. Oh, so there's our dog. I always have to throw a dog in here because we're all virtual. We don't have a dog to pet at work, but I realize that this information may be new to some people, and it's a little hard to understand. Just know that if you do own a business and you do have a financial tracking software like QuickBooks, I would really encourage you to just delve into your numbers. I have to, full disclosure, I have an MBA, but I can say that I really didn't get this stuff until I started double clicking on my QuickBooks reports. And I would run a balance sheet, and I'd double click on the number in the balance sheet, and it would take me down to show me where that number actually came from. And that's when it really started to click for me. So if you do have QuickBooks or some other system that you're using, just keep doing that. And if you don't, then you can also talk to an SBDC advisor about getting you set up. But we have one more major statement that we want to look at, and that is the statement of cash flows. And again, this is the thing that helps you understand the flow of cash in and out of your business. And when we talk about cash, we're talking about the hard green stuff, but we're also talking about checks, credit card payments, Venmo, whatever it is, whatever's in your bank account. And so the big question that people ask is, why is that different than income and expenses? And why, at the end of the year, I've heard this question before, my company made a profit, but the money's not in my bank account. So let's talk about why that can happen. So the answer to the question is, why is it different than income and expenses? It's almost the same, but it's not quite the same. And so it's in that not quite part that we're gonna look at. So one of the big reasons is that transactions that involve money in and out of your bank account don't show up on the income statement at all. One of those things is asset purchases. If you go and you bought some equipment and it has value, so you don't put it in as an expense of your business that year, because expenses are things that got used up in that year. But when you buy something that is value into the future, you put it on your balance sheet. But money left your bank account. It's not on the income statement. So you can't rely on your income statement to show you that money that came out of your bank account. The same, and a really common one, is the principal portion of your loan payment. So a lot of small businesses have loans that they pay every month. And then each payment, it's made up of interest and it's made up of principal. The interest part you can take as an expense to your business because it's the cost of doing business. You have to pay to get the loan. The part that you pay back, just to pay back the money you got in the first place, that's all happening on the balance sheet. Remember that liability section that showed the loan? Well, when you make this payment and you go into QuickBooks, the principal part goes to reduce that liability amount until it gets to zero. That could be a lot of cash that left your bank account that did not show up on your income statement. So those are two big reasons. Another one is that not all transactions actually involve cash at all. And one of those is depreciation. So depreciation, if you're not familiar with that, is basically you're allowed by the IRS to show the loss of value of your assets every year and to take that as an expense. So remember, we buy our truck, we book it as an asset to our business, not as an expense that year, because it has value over time. But it does lose value every year the more we drive it. So we take that as an expense on our income statement. But you're not paying anybody depreciation. It's just reflecting a loss, but there's no depreciation board. You already paid for it when you bought the asset. So in this case, your income statement is showing you, in some cases, a very large expense that didn't involve cash at all. And then finally, this reason is probably the most important reason, is that when you invoice your customers who don't pay you when you see them, they're paying for it later. When you create that invoice in an accounting system, it's booking it right then and there as revenue. But that revenue is not cash. It's the promise of cash. It's an accounts receivable. So in that case, your income statement is showing you money that came in, but you haven't actually received it yet. And the flip side is accounts payable, that you showed an expense that's on your income statement, but you haven't paid for it yet. So all of these things impact cash flow. So what we do with a cash flow statement is this is just basically like a massive detangling kind of financial statement that helps us figure all of this out. So what we do is, like I said, it's almost like an income statement, but not quite. So we start with that 46,294, that profit that we made, and then we back stuff out and we put stuff in based on whether cash actually left our bank account. So there's three parts: operating, investing, and financing activities that we look at. And so, for example, I booked my accounts receivable as part of this number, as part of my income, because I sold my pies to the grocery store, but they haven't paid me. That's in my accounts receivable. So I'm going to back that out because I didn't get the cash. Flip side is credit cards and accounts payable. I booked these things as expenses that I paid, that I used my credit card for, but I haven't actually paid the credit card company yet. So that money is sitting in my bank account. I'm going to add that back in. Down here, my business bought some equipment. and they used the bank account to pay for it. So the money left the bank account, but because it's equipment and not an expense, it's an asset, it showed up on my balance sheet. It didn't show up in this number. So I'm going to back that out. And the flip side of that is depreciation. I took the expense, it's in this number, but no cash left my bank account. So I'm going to put that back in. Down here is mortgage. That represents that principal portion that we talked about that's not on the income statement. So it's not in this number, but so I have to take it out because the cash left my bank account. Same with the owner's draw. I took money out to pay myself, but that affected the balance sheet, my equity position, not my income statement. So we look at all of this, and what's most important is this. What this is telling us is that our income statement showed us that we made a profit of $46,294, but for the year, we only added $13,810 to our actual bank account. We started the year with $22,000, and we ended the year in our bank account on January 1st, and we ended it with $35,000. That's why this is so important, because you need to see the flow of money in and out of your business. Otherwise, you might run out of money. So you need to understand what impacts cash flow. This statement is looking at your history though, right? And for a lot of small businesses, you need to look to the future, and you need to determine if there's going to be a point in time where you might run out of cash. So you can take this information and use it to project forward for the next year. That is done on a cash flow projection. This is not one of the big 3 financial statements, but it's a tool that we use a lot. This is a made-up cash flow projection for a seasonal business, and it's projecting out 6 months. I owned a seasonal business and in a restaurant, and so this would happen to me. I would start January 1st. In this case, this business has $12,000 in its bank account, but there's no money coming in because I'm closed, right? But I've got expenses. I've got rent and utilities and all those fixed expenses that I committed to. So at the end of the month, I've got $9,250. So I put that number up to start my month in February, and I go through the same thing. I don't have any money coming in. I've got money going out. And then you'll notice that on the bottom, there's this red section there. I am projecting that I'm going to run out of money. So this is not entirely uncommon, but you do need to manage it and plan for it. And the ways that you can plan for it are you can talk to your bank and get a line of credit. You may own and in a restaurant, you have to pay staff to come in and open it up and clean it up, and you need to paint and repair stuff, and you need money to do that. And that's a line of credit can help you with that. But you want to tell the bank, not in March, you want to tell them in December that you're going to need this money. Another thing you can do is not take all your profit home and leave some in your bank account for working capital so that this number is bigger. Another thing you can do, and this is a really important one for small businesses, such a critical thing to do, is to invoice your customers right away if you use invoices, and to be really clear about the terms. So whether it's, they need to pay it when they get the invoice, or you're giving them 15 days or 30 days to pay. If they don't pay, that there's consequences to that. And I know small business owners don't like to harass their customers, but you need that cash. Another thing you can do is talk to your vendors. You might be able to extend your own credit with them so that you pay when you have the cash. And I used to do that with my mortgage. I had a huge mortgage, and I paid it in 4 installments every year when I had the most money. So that was in July, August, September, and October. I didn't pay anything in January, February, March, and that gave me quite a bit of relief. So that's another thing you can do, is talk to your vendors or your lenders. And finally, I just want to leave you with a story that I heard at at a conference, which was an SBDC advisor from another state, had been working with a really successful bakery. They were super excited because they got this huge account to provide baked goods to a big box store like a Costco. So they bought all the ingredients, they made all their stuff, they gave it to the store. What they did not look at were the terms, and they found out that the terms they had with their vendors for all of the ingredients was 30 days. Costco didn't pay them until 45 days. They almost went out of business because of this, because they did not manage cash flow. So this is why it's so important to understand. So just to summarize, going back to our tree, the apples, that all gets tracked. Your growing and selling of your apples gets tracked on your income statement, and you start again the next year. The balance sheet is showing you everything about your business, most particularly your net worth or your equity, and you want to grow equity over time so that your business can stay strong, so that you can reinvest in outdated assets, try new things, try new products. And a healthy balance sheet allows you to do that. And then the cash flow statement, you can be really profitable but run out of money. So you need to keep track of that on your cash flow statement. So those are 3 different statements that together give you the complete entire picture of your business. It really is important that you take the time to review your numbers. Ideally, you're doing this on a monthly basis, if not quarterly at a minimum. And again, if you are a small business owner and you are not tracking any of this, other than throwing some receipts together and giving them to your accountant at the end of the year, you're not alone. But I think this year, more than any year we've ever had, has taught us the importance of understanding what's happening in your business. And an SBDC advisor can help you figure out what financial tracking system to use. And or if you're using something like QuickBooks and you think it's all messed up, we can look at it and see if we can untangle what's happening, or we can just look at your books and help you do that analysis to help you understand whether you're in a good position or not. So that's it for me. Oops, sorry. There we go. But I'm happy to take questions, and I talk about this, nothing stupid. And I know that, some of the stuff, especially the balance sheet and the relationship to the income statement, is probably the thing that confuses people the most.
Well, thank you, Tina. I feel like I've sat through a couple of these presentations of yours, and I am flabbergasted every time with how much information you have. It's a lot. I understand it's a lot for everybody, but you definitely make it very approachable. So we appreciate that. So yeah, if you have any questions for Tina at all, go ahead and submit them in the chat. We don't have any questions yet, so you could sneak in there and get all the attention. You were fast enough typer.
And like I said, a lot of these are often really specific to your own business. So it's a good opportunity to just have an advisor look at your books. And if we can't do your books for you, but we can refer you to bookkeepers if you need somebody, or we can just kind of look at what's happening.
Yeah. So Rhonda's asking, paying mortgages quarterly, doesn't that affect credit rating? And aren't you paying interest late payments?
Nope, because it was something that actually I purchased a business, and the prior business owner did this. So the bank was used to this, and they had actually suggested it to me. And no, it was our agreement. So that was not a late payment. I didn't just decide to do that. They would have definitely not liked that. But no, it was an agreement with the lender. And they did that with a lot of seasonal businesses.
That's great. So those were like the terms that everyone agreed to in that case.
Yeah,
definitely talking to your bank. I mean, in particular, it feels like here in Maine, we are more apt to be neighborly And so depending on what your relationship is with your bank, that you have options in that cases. Also, credit unions tend to be very accommodating as well. All right. Rue is asking, can you tell me again where grant money should be listed?
That I'm going to punt to your, ideally you're working with an accountant or a bookkeeper, but it depends. Some of these grants, like the PPP, are you do not have to claim them as income, but you can still take the expenses. So where you put that, I've seen, I have to tell you that I've seen bookkeepers offer different advice on this. I talked to one bookkeeper who said that it should be booked into an equity account rather than an income account, which I thought was kind of unusual. And I've also seen people say book it as other income. You don't want to book it as revenue to your business, but you still you're still going to have to back it out because you don't want to. The IRS has told you that you don't have to book this as revenue to your business at all. So, so you want to eventually take that out because that's going to affect your profitability. So I have heard different answers from different people, including CPAs. And I guess I would say if you are working with somebody, talk to them. I know that we have a consultant on that we're working with who has told people to put it into the other income line.
So it sounds like that's what they've been doing, the other income. So
yeah.
All right. Where do you put donations or charitable contributions?
You can just have in your chart of accounts, you can just have a contributions expense. It's an expense of your business. So you can just have donations, contributions, whatever you want to call it, but it's an expense account.
Great. What about tracking costs of goods sold for service-based businesses?
Excellent question. So there's no law that says you have to track your cost of goods sold. It's just a good practice, but it is typically associated more with product-related businesses, but you can track time. Say you're a massage therapist and you want to see how efficient you are from the time you start to the time you finish. You can put that in there and track it as a service, just your time. That's the only thing you're really tracking. Again, you don't have to, but it can be helpful just as that analytical tool that we talked about.
That makes sense. Other than QuickBooks, are there any other accounting software programs you would recommend to a small business to look into? It seems like you're a diehard QuickBooks fan.
No, in fact, QuickBooks is a great, very robust accounting system. There's, you can either get the desktop version, which is much more cost effective than what they are now offering, which is the online versions, which is a subscription service. The subscription service gets really, really expensive, to tell you the truth, for a small business. So I'm always a little bit hesitant to recommend it, but it is probably the best accounting software program out there for small businesses. There's another one called Xero, but that Xero, that's used in Europe a lot. It's an Australian company. But there's also one called Wave. I have not used it, but it is free. And it is a software program that I think if you're just starting out might be one to consider, especially if you're like a solopreneur type person. It is owned by Merrill Lynch. It is a legitimate software program, and they actually don't have advertising. They apparently get their money from selling other services like payroll services. So you might want to check that out. Wave.
Well, that leads into the next question, which is how do you manage payroll and sales tax?
That's a big one. Here's what I would say about payroll from my own experience. It is so worth it to work with a payroll company or a payroll service, or to buy software that you can attach to accounting software like QuickBooks. You can buy QuickBooks Payroll. because it can be kind of complex to figure out the payroll taxes, to figure out on top of the taxes, you have to file quarterly payroll tax returns. It was the best thing I ever did in my business. It allowed me to sleep at night, was when I started to work with a payroll company. So, you know, I know some people do it even when they just have a couple of employees, and you can sometimes, there's banks, I know local banks offer payroll services. Bangor Savings, I think, will do it for just one employee. So that's how I do it. You know, it's an expense, but the time that you put into figuring out payroll, it's usually worth it for most businesses.
And we are trying to set up a session with a payroll specialist who would be able to answer your questions. We are going to need to postpone that till the future, and we are unsure when that date is. So keep an eye on our webinar schedule for that. We do have someone asking, so they purchase materials ahead of time for DIY classes, and then they get reimbursed by the students for what is used. How should they claim those reimbursements in correlation with the expenses of the materials?
I, first of all, want to tell you, I'm not an accountant, so you should always talk to your accountants about these kinds of questions. And I will tell you that within something like QuickBooks, there's you can set up an account in the chart of accounts called Ask My Accountant, which is one of my favorite tools. If you don't know the answer to something, just code it with that and collect that information for when you talk to your accountant. If you're getting reimbursed, a lot of people will show that as one idea, is to show it as an expense, and as you get it paid, you put those payments into that same account, expense account, and it gets zeroed out. So that's probably how I would have handled that. But again, I'm not an accountant, and that's something that you should ask your accountant, because there may also be some tax consequences associated with this that I'm not aware of. I also wanted to say, someone had mentioned sales tax. So sales tax, it's depending on your business, it's really important that people understand that collecting sales tax is actually a liability on your business, because you owe that money to the state government. It's not your money, so it should not be collected as revenue. It should go into a current liability account called sales tax payable. And then when you go and you make your monthly or quarterly payments to the state, the money's coming out of that balance sheet account. It's important that that gets separated, because it's money you're bringing into your business that doesn't belong to you.
Yeah, and it's one thing to mess up your own books. It's another thing to mess up the federal government's books.
Yeah. If you don't know how to do that, the mechanics of that within QuickBooks, you know, an SBDC advisor could probably help you, or certainly, you know, you want to be talking to your bookkeeper or accountant about that, but not your money, liability, not your revenue.
Yeah, so all of this information comes with a disclaimer of, we are not accountants.
That's right.
We want to support you however we can, but we highly recommend that you speak to a professional accountant about any of these questions. We do have several sessions that Tina did previously about QuickBooks, and I can include the links to those recordings in my follow-up email. They're mostly like, what's the difference between the charts, I believe, and also like, should you buy the desktop versus the online version? So they again, there are overviews, but if you wanted more QuickBooks specific information, I will include that so you can follow up. I don't see any other questions in the chat, so I mean, jump in there. It is 11 o'clock and we want to be respectful of everyone's time. So thank you all for joining. Tina, thank you so much as always. This was great. Just keep an eye out for my follow-up email, and otherwise have a great day.
Yeah, see you guys.